Have you ever looked at a stock chart and it's just a chaotic jumble of lines? Well, what if I told you that chart is actually telling a story? A story of investor hopes, fears, and all the battles in between. And today, we're going to learn exactly how to read it. Let's dive in.
So how do they do it? How do analysts look at all this past data and get a sense of what might happen next? Well, it's not magic, and it's definitely not a crystal ball. It's a skill called technical analysis, and it's all about finding the clues hidden right there in a stock's price and volume.
And to crack this code, we're going to use a real-world example, Honda Atlas Cars Limited, or HCAR. Now, a super important note here. This is not, I repeat, not investment advice. We're just using this company's chart as a learning tool to see all these concepts in action.
All right, first things first. The very first thing any analyst does is just zoom out. Before you get lost in the day-to-day noise, you have to get the big picture. What's the main story? What's the overall trend?
And the most basic tool for this, but honestly one of the most powerful, is the trend line. It's exactly what it sounds like. You just draw a straight line connecting the highs or the lows on a chart, and boom, that simple line cuts through all the daily static and shows you the real direction the stock is heading.
So, when we do this for HCAR, the story starts to become pretty clear. We can draw a trend line right across its recent peaks. And what do we see? A sideways to bearish, basically a downward pattern. This line tells us that every time the price tries to rally, sellers jump in at a lower and lower price. That's a classic sign of consistent selling pressure and, you guessed it, weak investor sentiment. Okay, so we've got the general direction, down. The next move is to map out the key battlegrounds on the chart. These are specific price levels where the fight between buyers and sellers gets really intense. We call these support and resistance. Think of it like this. Support is basically a price floor. It's a level where, in the past, a whole bunch of buyers have stepped in and said, nope, not going any lower, propping the price up. Resistance is the exact opposite. It's a price ceiling. It's where sellers usually take control and stop the price from going any higher. For HCAR, you can see these battle lines pretty clearly on the chart. There's a support level, a floor, that's been tested a few times and has held up so far. But if the price breaks below that floor, well, that could trigger a whole new wave of selling. And up above, there's that resistance ceiling that the stock just can't seem to punch through. If it ever does, especially with some power, that could be the first real sign of a recovery.
Now, trend lines and support levels are great, but they can get thrown off by short-term craziness. To get an even clearer picture of the real underlying trend, analysts use a tool that smooths out all that volatility. It's called the moving average. A moving average is just the average price of a stock over a specific time frame, like the last 50 days, or maybe 200 days for a longer-term view. What it does is filter out all those random daily spikes and dips. This gives us a much cleaner, more reliable look at the stock's actual trajectory.
And this is where things get really interesting. When you put two moving averages on a chart, one short-term and one long-term, the way they interact can give you some incredibly powerful signals. And in HCR's case, the chart is showing something called a death cross. Sounds pretty dramatic, right? Well, there's a reason for that. It's considered a really bearish signal.
So what is this spooky-sounding signal? A death cross is pretty simple, actually. It's when a faster, short-term moving average, like the 50-day, crosses down and through a slower, long-term average, like the 200-day. This is a big deal because it signals that the recent downward momentum is so strong it's now dragging the entire long-term trend down with it. It's a huge red flag for potential, long-lasting downtrend.
All right, we know the trend's direction, but what about its strength, its speed? Is all this selling pressure picking up steam, or is it getting tired? To figure that out, we need to measure momentum.
So our first momentum tool is called the Relative Strength Index, or RSI. The best way to think about the RSI is like a speedometer for the stock. It's a little gauge that goes from 0 to 100, and it tells you how fast and how much the price has changed recently. It's perfect for spotting when a stock might be moving too far, too fast.
And here are the really simple rules for reading that speedometer. If the RSI goes above 70, it suggests the stock is overbought. Basically, it's gotten a little too hot and might be due for a cool down. If it drops below 30, it's considered oversold, which means it might be due for a short-term bounce.
Now, looking at HCAR, if its RSI were to dip below 30 into that oversold area, that doesn't mean the whole bearish story is over. Not at all. It just adds a little nuance. It suggests that even inside that bigger downtrend, the selling might have gotten a bit carried away in the short term,
and a little relief rally could be in the cards. There is one last absolutely crucial piece of the puzzle we need to look at: volume. Trading volume is just the total number of shares that are traded. Think of it as the conviction meter. It tells you how many people are actually participating in a price move and how strongly they believe in it.
And why is this so important? Well, a price move that happens on high volume is taken way more seriously. It means a ton of investors are involved, which makes the move feel more legitimate. On the flip side, if you see a price breakout on really weak, low volume, analysts get suspicious. They often call that a false breakout, and they figure it probably won't last.
Okay, so we've looked at the big trend, we've mapped the battlegrounds, we've checked the underlying momentum with moving averages, and we've measured conviction with RSI and volume. Now it's time to play detective, put all these clues together, and see what kind of picture they paint.
So when we put it all together, we get a two-part outlook. In the short term, yeah, if that support floor holds and the RSI suggests the sellers are exhausted, a little bounce back up to that resistance ceiling is definitely possible. But for the medium term, the verdict is pretty clear. The bigger story, the one told by that death cross and the downtrend line, is still bearish. And that story only changes if the stock can decisively break above its key resistance level, and this is the key part, and do it on high volume. Look, at the end of the day, the single most important thing to remember is this: none of these tools predict the future. Technical analysis is not a crystal ball. It's more like a framework, a way of organizing the evidence from the chart so you can weigh the probabilities. It's all about identifying key areas, understanding the potential risks, and mapping out the possible scenarios that could play out.
Which kind of leaves us with one last question to chew on. The tools themselves, the lines, the averages, the indicators, they're all based on math and data. That part's a science. But knowing which tools to use, how to read them when they're giving you conflicting signals, and how to manage your own emotions in the middle of it all, well, that starts to sound a lot more like an art, doesn't it?